Now, ladies and gentlemen, the big thing we're obviously talking about now is money. And this relates to all of us. I know a lot of you are business majors. We have some non-business majors here. So when we're talking about money, I want you to think of it in the sense of your own financial independence. If you get this financial independence in place, you're going to open up a lot of other doors for other independence in other elements of your life. So in other words, I don't ever want you to use or depend on anyone else as a financial crutch. That's always important to remember. Don't depend on anyone else as a financial crutch. Real quick background on me. How the heck did I get here? My original career goal from the time I was a little kid, I initially wanted to get into TV news. I wanted to be a news anchor, a reporter, or a meteorologist. So I went off to Shippensburg University. Now, no one come after me, but my brother went here to Kutztown. So see, I could still relate. But I went to Shippensburg University for communications journalism, had an earth science minor for that interest in meteorology. And, you know, after a couple of years, I thought, maybe this isn't the best fit for me. And I know in this next pic, I look like Mickey Mouse with my radio headphones on. But sometimes you might find that. You study for a certain career, you get into it, and after a while, it's not quite the best fit. That's okay, it happens. But what I've learned along the way, you always got to give any new job time to learn the ropes. You're not going to know it after 2 weeks, 2 months. You got to give any job at least a year, maybe 2 years to get in your comfort zone. If it's not working for you, move on to the next thing. Nice thing is, any skills you learn in one job, they're always going to apply in the next. So my first full-time position out of school, out of Shippensburg, was with the Commonwealth of Pennsylvania, but I started in a different state agency, Pennsylvania Department of Human Services, back in 2001. As a human resource analyst. In a nutshell, I had to hire and fire people. Now, trust me, despite what you see on TV, firing part of the job, no fun at all. But thankfully, I was also able to see employees leave under better circumstances because I also had to process their retirement transactions. So here I am, punky kid just out of school. Here's employees who had been working 30, 35, 40 years, and they're telling me over all these years, they got in this habit. Every paycheck, they are always taking some money out, putting it in long-term savings and investments in their own personal retirement plan. Well, after all these years, they built up this nice nest egg, and then they combine that with the workplace retirement plan. I saw some employees, as they retired, they were able to move off to another state, to buy or build a new house they always wanted. But ladies and gentlemen, not going to kid you, it was not always fun and games all the time. I'll never forget one gentleman had to retire early to take care of his son. Son was in a bad car accident, burned over 50% of his body. Health insurance didn't cover all the costs. He needed that nest egg money for a very important reason. So this job, this is where I saw firsthand the power, the importance of saving and investing on an everyday, real-world basis. So this is where I had to give myself a crash course in investing. I had to teach myself what's the difference between saving and investing, what's the difference between a stock and a mutual fund, what exactly is an IRA for retirement, because I saw how important it was to learn about this stuff. And bottom line, remember, I was not a business major. I was communications journalism. If I can learn this, anyone can. I know a lot of you are studying for this, and you're getting two benefits here. You're developing some great career skills, but also you're learning how to develop your own personal finances. And for any non-business majors here, again, I'm the proof. I was one of those communications journalism majors who you can't teach anything. I taught myself this. So that's why we have all those handouts and bags in the back table. On the way out, you grab whatever you want. If you want one of each, go for it. I'm going to reference some of them as we go through. But bottom line, you want to give yourself a little bit of knowledge on this stuff. We're going to take a quick look at a video segment here. Clearly, this gentleman is a lot older than a lot of you, but you're going to see he got in this habit of saving and investing over the years. Two things I want you to keep in mind. First off, for those of you who are business majors, maybe you want to become a stockbroker, an investment advisor representative, think about this gentleman. Maybe he might be coming to you at this age when he wants to preserve his wealth in retirement. Or maybe a younger version of this gentleman will be coming to you in his 20s who wants to start out building up a nest egg. So how would you work with this individual? And then all of us can relate to this habit he got into. Also, do me a favor, halfway through the segment, he references something about dividends. Dividends, as some of you may know, are what you earn off of investments. Listen carefully to what he says about the dividends. What he does is really important with them.
Not long ago, I met Earl Crawley.
Yeah, how you doing?
But everyone here calls him Mr. Earl.
We can talk about some finances.
He's worked as an attendant at this parking lot in Baltimore for 44 years.
So you really think it's going to improve the gas?
Funny thing, though, everyone was asking Mr. Earl about money.
Nickel and dime, nickel and dime. That's right.
Is that booth his pulpit where he's preaching the gospel of investing?
Sure is. He makes my day every time I see him.
Oh, come on now, seriously. Investing?
How you like that gold now?
670.
Earl told me he's never made more than $12 an hour, never earned more than $20,000 a year.
How you doing?
So how could he know something about corporate profits?
Spider's gonna get
I had to pry. So Earl, what's your net worth?
$500,000.
$500,000
Yeah,
from working here.
working here.
That's amazing.
My last statement.
And there it is in his statements, over $500,000 net worth on a parking lot wage. Now Mr. Earl had my full attention. How did he do it?
Stop working so hard and let the money work for you.
Earl's first lesson came at age 13. His mother had him working the fruit stalls to help pay the family bills. He got to keep just a few quarters for himself.
From the time my mother started taking my money that I earned on Lexington Market, that it wasn't money just to be thrown away. It was there to be used.
Economics aside, Earl had another obstacle to overcome.
Tebow is
He tells me he's dyslexic. Back in the 50s, that meant settling for a life of low-wage manual labor jobs. So Earl figured he'd better sock away what little money he was making. It was just $1 here and $1 there, starting with savings stamps, and that led to savings bonds. At 26, he got married. And by the late 60s, Earl was feeding 3 children on a meager $80 a week.
It was tough, but because we had to sacrifice a lot.
And the budget only got tighter when Earl and Beverly opted to send their kids to Catholic school instead of public school, which was free. Earl took extra jobs to pay the tuition, and you better believe he made every penny count.
Elementary school, I would ask for lunch money, and he would give me $1, and lunch was 85 cents, and he would reply before I walked out the door, "I want my change."
As the years rolled by, Earl kept saving what seemed like meaningless amounts. He started investing $25 each month into a mutual fund and did that consistently for 15 years. By the late 70s, his net worth was $25,000.
Later, as the children got older, he decided to play the stock market. And he bought 1 share, and, well, the rest is history.
He bought stock in blue chips like IBM and Coca-Cola that paid dividends and...
Instead of taking the dividends and pocketing it, let it set or let it reinvest itself, and it increased my shares. And the more shares I had, the more dividend I had. Eventually, the more money I have down the road.
So where did this so-called slow learner learn so much about mutual funds and blue chips and dividend reinvestment plans?
You're going to split this year.
It all comes back to that parking lot. And this is my favorite part of Earl's story. You see, his lot is smack dab in the middle of a financial district where he picked the brains of brokers and bankers and lawyers for their financial advice.
What's going on? You got any advice for me today in the markets?
No, I'm just trying to find out something from you.
All right.
Talk to everybody and listen to advice that everybody give me and take it from there.
Earl, why don't we take a look at what you've got in the portfolio now? and
Earl
see-
had trouble reading, so instead, he listened. He believed in the power of compound interest and stocks for the long haul. Which brings us back to the present. Today, Earl's stock portfolio alone is worth more than $500,000. And yes, his house is paid for. And no, he doesn't carry any credit card debt.
He's somebody to emulate not only as an investor, but as an individual, and how to live your life and make the best of what the Lord gave you.
All right, as we come out of that segment, what I need everyone to always keep in mind is you're not going to make $1 million overnight by picking some hot stock. It's not going to work that way. I did cross country and track when I was in high school. I still do marathons and half marathons today. And yeah, here I am sprinting across the finish line. I got some height as I'm bounding across the finish line. This is not the way investing works. You're not going to make $1 million overnight. Instead, you're running a full-blown marathon, a financial marathon, 26.2 miles. Here I am at mile marker 20. Yeah, I'm looking a little fatigued, a little haggard, a little worn out. That's normal for any marathon runner at mile marker 20. It's also normal when you invest over the long term. You're going to get periods where your investment portfolio is down in value. However, most long-term runners, endurance runners, will finish the race. Why? Because they trained ideally for 16 weeks ahead of time. They train themselves physically and mentally. When they hit those low points, they know how to keep going. Well, most long-term investors, they train as well. Again, that's why I brought those handouts. That's why you're taking these classes, to get some knowledge, to give yourself that financial training, so when we hit those hiccups in the markets, you won't panic. So remember, when it comes to building up your money, whether it's for yourself or potential clients, it's a financial marathon. You're in this for the long run. Next key point, the difference between saving and investing. When we're talking about savings, that's money in the bank or the credit union. That money's safe. It's going to be there for when you need it. Generally, we say this money is for your short-term goals. We define a short-term goal as any goal that's less than 10 years away. You want that money to be there, whether it's a need or just something that's coming up. Now, if I was standing up here just a couple months ago, I would have looked a little bit different, had a little bit of a space in the front of my mouth. I had a bridge that came out. Bridge is basically a false tooth. The baby tooth never came in for me, so I always needed a bridge in there. A couple years ago, it started coming loose. The dentist said, Doug, let it in there till it pops out. It's the easiest thing to do. Well, thankfully, I had a couple years preparation, because even though I have health insurance, dental insurance, insurance won't cover all the costs. This was still going to be $800 out of pocket. So I added another category to my money breakdown, and I need everyone to start doing this now and do this indefinitely. Come up with some type of money breakdown for yourself, and you determine what's best for you. These are some topics that I thought might be relevant right now. You tweak the amounts, the percentages, the categories, and you're going to be able to keep up with this. And I could pretty much guarantee you, you get in the habit of this and you stick with it indefinitely, you're going to avoid any situations where you go underwater financially. Don't get panicked by the next part of this slide. This is kind of what my money breakdown looks like right now. And I have a lot more categories. I can't fit them all in there. But again, what's going to get easier down here at the bottom, if you're in the habit of doing this now, you slowly add in these other categories as you get older. You don't have to do it all at once. And it's not all gloom and doom up there. There's a social category, there's a travel category, because yes, believe it or not, fun stuff will come up in life. I can guarantee all of you, you'll be asked to be in at least one wedding party in your life. I've been in 4. The most recent one was back in summer of 2014 for my good friend Jay. Looking at the pic here, we grew up together. We have been best friends ever since we were little kids. Looking at the pic, it looks, you know, we're in front of the water there. You might think we're down at Penn's Landing by Philly, Inner Harbor by Baltimore. You would think that. We were actually in Istanbul, Turkey, because Nil, it turns out, is from Turkey. So when I was asked to be in the wedding, sure, I wanted to be in because it's a very good friend. And then when I heard Istanbul, I'm like, where am I going to get the money from this? However, I've been building money up in my money breakdown, in my budget. So I had it. Now, I'm not going to kid you. I kind of had that money planned for something else, but this was a very good friend. The last thing I wanted to say is, oh, I don't have the money, or oh, I don't want to go. That's the nice thing with breaking your money down. And we didn't just do the wedding. We turned it into an 11-day vacation. We traveled all over. I got to hang out with his other friends because I was the only hometown friend who went. All his other friends from his college. He went to Pitt, and I will say I represented the state school as well. So now, you know, Shippensburg, Kutztown, all working together. But it ended up being a really nice event. And it was nice because I broke the money down in these different categories. Then when I got back, there was wedding number 2. He did a wedding here for his family here in Pennsylvania. So there was another wedding in the Poconos. I had that money taken care of for the breakdown. And then there was the bachelor party, of all places, in Las Vegas. Now, no shenanigans happened, but I had a decline on the bachelor party because my money breakdown told me I could afford to do both weddings. I could not do the bachelor party. So although this might seem simplistic, it helps you visualize that money. Again, it's going to help you avoid the situations where you go underwater financially. This really can help you visualize it for where your money is going for both the short-term and, yes, the long-term goals. And this leads us into our next key point when it comes to investing. What's this word here in red? Everyone yell it out, please. Exactly. When it comes to investing, I want you to think of it like a ride on the roller coaster. It is normal for a roller coaster to go both up and down. Stock markets, many of the other financial markets work the same way. You're going to have that normal up and down in the markets. You're going to get that up and down in your own portfolio as well. That's a normal part of investing. But remember, when you're investing your money, this is for those long-term goals, 10 years out or further. You don't need this money right now. So any money you're putting into investments, that's what you can afford to take a risk with because you don't need that money right now. But here's where the trade-off comes in. Let's say you're asked to be in a wedding party this summer. That's a short-term need. You don't want to just rely on the investment money. If you try to sell right now to pay for this wedding party in the summer, what if we're in a period of a downturn in the markets? You try to sell, you're going to take a loss, you're not going to be able to afford that wedding party. So priority number one is savings. Get a good chunk of money built up in there first. Then once you build up enough, out of each paycheck, some money goes into savings, some goes into investments, and this is going to give you the bigger earning potential because you are willing to take on some risk here. So that's what you want to keep in mind. Now, as we look at some basic ways to invest, we're going to keep our eye on the risk key up here on the screen. We're going to come back to the screen several times. And if you want to get a better handle on risk and just how important it is when it comes to investing, on the way out in the back there on the table, grab the 5 Keys booklet. Pages 4 through 6 do a great job of explaining the importance of risk with investing. Most common type of investment that's out there, obviously stock, ownership in any publicly traded company. And when you buy stock in a company, that's where you own it in units called shares. That's how you own the stock, and you determine how many shares you want to buy of a particular stock. Obviously, in terms of picking companies, there's hundreds, there's thousands of companies you could buy stock in. And the big key is you could buy a lot of shares one time only, you could buy it once or twice a year, or you could even set it up per paycheck. Every time a paycheck's coming in, so much money comes out, you go and buy another round of a particular stock. When it comes time to buying stocks, and I tell this to students and adults alike, don't just buy Starbucks stock because you like hanging out there or because there's always a line of people out the door. It takes a little more than that to truly make good investment decisions. You got to go in there and do some research to really make sure that this stock you want to buy looks like it's going to go up in value over time. So don't just be picking companies you like, do some research on it. Very, very important. In terms of making a profit, pretty obvious for the first way, where you sell at a price higher than when you purchased. So maybe, for example, you bought Walmart, $45 a share, you did some research, it looked like it would likely go up over time. Maybe 10 years from now it's at $50, $53 a share. There's where your profit's going to come in. The other way to make a profit, or at least enhance those profits, is through the dividends. We heard Earl talk about this just before. Dividends, in a nutshell, is when the company makes a profit. If a company's been profitable, it's going to share that profit with its shareholders. And this is going to vary from one company to another. Not all companies do this, so do your homework to see what companies pay a dividend. But the dividend payment is going to be in relation to the number of shares you own. The more shares you own, the bigger that dividend payment's going to be. You got about 3 options when those dividend payments come in. Number one, you could spend it immediately. That's generally not recommended. Remember, for most general consumers, investing is for those long-term goals. So you want to build that money up. Option number 2 would be whenever those dividend payments come in, set that aside within your savings account, build up a couple $100 or maybe $1,000, then go in and buy another round or another lot of shares. Or option number 3 is what Earl talked about. As soon as those dividends come in, he immediately goes in and buys another round of shares with that dividend money. So options 2 or 3, very good to enhance the power of the dividends. You want to read more on dividends? Grab the Basics booklet, page 6 on the way out to get a better handle on dividends. Now, when it comes time to picking individual stocks, sometimes people will say, well, you know, I'm new to this, I don't know where to get started, but I know I love to shop, so I'm going to buy all my favorite clothing company stocks. Well, on the surface, that sounds like a good plan, but very quickly that could become very dangerous, ladies and gentlemen, because let's say that's all you have in your portfolio. You only have clothing company stocks, nothing else. 10 years from now, you go to sell them maybe to make a good down payment on a house or a car. Maybe 10 years from now, we're in a bad economy. General public's not buying a lot of clothes at the high-end stores like Hollister and Gap and Macy's and Nordstrom. You try to sell those clothing company stocks, you're not going to make much of a profit at all. You're not going to be able to afford that down payment. So, in other words, don't put all your eggs in one basket. It is important to diversify. Have a whole mixture of investments in there. Maybe just 2 or 3 clothing company stocks, 2 or 3 tech stocks like Dell, Google, Yahoo, Facebook, maybe a car company stock, maybe an airline like United, maybe some household stocks like Nestle, Hershey, Coca-Cola, Pfizer. You want a mixed bag, so if one sector's down, another might be up. You get that balance in there. And ideally, to have a well-diversified portfolio, you're going to need anywhere from 15 to 50 different investments that are out there. Now, some people will say 15 to 50 different stocks, that's going to be a little bit too much for me to maintain. That's an individual choice. Some people like to track the stocks and gradually buy and sell some over the years, but some people get busy with work or family life. They don't have a time to keep up with all these individual stocks. So there's other ways to do it. You might, maybe not necessarily right now, but in a couple of years, maybe you want to work with a professional, like a stockbroker or an investment advisor representative. In the back, we got the Getting Help booklet. This explains the different categories of professionals. There's also a blue trifold called Cutting Through the Confusion and a white sheet called The Title Behind the Name. 3 of these booklets do a great job of explaining the different categories of professionals. And again, if you think you want to work in this industry, this is also going to give you a little more insight as to some of the professions that you could do. So that could be a way to invest if you don't want to pick all these individual stocks, or there's other products out there. There's another product called a mutual fund. And basically with the mutual fund, I always like to equate this to a basket, except this basket is pre-packaged. You don't have to worry about filling it yourself. When you go to a mutual fund company, you could do this online, you could work with a professional. This mutual fund is going to be filled with hundreds, maybe even thousands of stocks. So basically, you get an expert from that mutual fund company who will pick the stocks, and they'll worry about the diversification for you. So you get a couple hundred, maybe a few thousand stocks all in this one fund. Could be a very easy way to diversify. Now, we do have a mutual fund booklet back there as well. You could grab the mutual fund booklet because you will learn not only can you get a general fund, there are some very specific ones. You could do a mutual fund that only has tech company stocks or only oil and gas company stocks or only foreign-owned stocks. So you could be as general or as specific as you want, but in terms of starting out, could never go wrong with good generalized mutual fund. And there's some long-term investors for their long-term goals. They'll just have about 2 or 3 mutual funds in their portfolio, and that suffices to build up a retirement nest egg. But again, if you like picking the individual stocks, it's going to come down to your personal choice. Just want to make you aware of some of the options that are out there. Now, we said before, when we invest in stocks, it's like what ride at the amusement park? Exactly. When we hit that downhill plunge, we don't want all of our long-term money to be exposed to those downhill plunges in the markets. We at least want to have some of your other money, your long-term money, in a slightly safer area, or in a safer area. So we do that through what's called asset allocation. When we're talking asset allocation, this is putting your money into multiple different pots, not just stocks or stock-oriented mutual funds. So notice the color change up on the board here. Now we're getting into fixed income products. A lot of times this is also going to include your bond and bond funds. So if we kind of need to think of this as a ride at the amusement park, kind of think of fixed income as a ride on the teacups. Clearly this ride much more gentle than the roller coaster. However, you know there's still going to be a couple adults who get a little queasy on the teacups, and you're not going to take your elderly grandma on the teacups either. So the point is there's still going to be some risk with fixed income, but not nearly the level of risk you would get with stocks. In terms of holding fixed income products in your portfolio, and this is just a general guide, point of reference, you might want to have it equate to your age. If you're age 25, maybe you want 25% of your portfolio to be in fixed income products and other conservative items. Then you use that as a gauge to determine if you want to be a little risky or go a lot more risky. That's going to be a general consideration for you to keep in mind. If you want to grab the bond booklet on the way out, you could do that. And again, we're going to get you out in time to make sure you grab those booklets so you can pick up whatever you want. But in our remaining minutes too, a couple other things that I want to go over is the final core area of asset allocation. But in terms of picking your individual investment products for fixed income, again, picking fixed income products, it's going to be like stocks. You could buy them individually, or again, the mutual funds come into play. This is where you could use the mutual funds to buy your fixed income products as well. Or as you read through the mutual fund booklet, you're going to see that you could even use mutual funds to do a combination of both stocks and bonds. Some mutual funds even become automatically more conservative over time. Final core area of asset allocation then is going to be cash. All right. When we think of cash, you can kind of equate this to a ride on the monorail. Anyone could ride the monorail, even grandma. No one's going to get sick on the monorail, okay? So you know you're not going to have a lot of earning power, but the money's going to be safe here. So if you've been investing for a while and now you're getting close to that investment goal or maybe retirement, maybe you want to move some or all of that investment money into your cash areas where it's going to be safe. You're not going to earn a lot, but if we hit a big downturn, you're going to be protected. And then, ladies and gentlemen, here's where we tie it all together. Looking at the long-term view of the markets from the early 1900s up to today, you can see we've gone in an upward direction. You know how you hear people say, invest for the long term? Here's your proof. But question for you, is this a smooth straight line? Absolutely not. Plenty of bumps in the road. There's even a couple of craters. Well, it's in these craters, this is where you get people panicking, freaking out. Sell everything you own. Get out of the stock market. It's a horrible time to be in. Ladies and gentlemen, especially with social media now, because it ramps things up even more. When we hit these low points in the markets, do not panic, all right? When we hit these low points, I think most of you know, we're talking about a bear market. I don't care how loudly that bear growls, do not be afraid. Actually, this is like a sale in the stock market. Price per share, those stocks, mutual funds, other investments, they're going to be really cheap. This can be an excellent buying opportunity. But you get some people who panic, they sell everything you own. That's the worst thing you can do. When you sell in a bear market, you lock in your loss. There's no way to make that money back. And look at this. Every time we hit one of these craters, we do come back up. Might take a couple years, but we will come back up. So bottom line, if we're in a bear market and you need money, that should never be coming out of your investments. It should be coming out of your savings, because that's going to cover your short-term needs and your short-term wants. And then, of course, when the markets do go up, when we hit these peaks or high points in the chart, this is where we're talking a bull market. Now your portfolio is worth a lot more. I want to quickly dive into asset allocation a little bit more, because this is where so many adults get messed up so often. Believe it or not, in just a few short years, most of you are going to be out working full-time. Believe it or not, we're talking retirement already. Most employers will require that a portion of each paycheck gets pulled out and goes towards your retirement account. Remember, we're doing that financial marathon. You got this nice long time horizon to build it up. So clearly, when you're starting out, a big chunk of your portfolio could be in stock-oriented investments. This is going to be like your growth engine. And when you're young, you're in an accumulation phase. You just want to accumulate a lot more shares. And let's say right when you start working at age 23, 25, we hit a vicious downhill plunge in that roller coaster ride. We're in that bear market. Well, sure, the dollar value of your portfolio, it's going to be down. But at this age, are you anywhere close towards retirement? No. So if you're putting in $50 each paycheck, just think how many more shares you're buying, because they're so cheap. Fast forward now to age 60 to 70, look at now, your portfolio has become a lot more conservative. And this is obviously time, or the age when a lot of people start considering retirement or some form of semi-retirement. And let's say right when you want to go to retire or semi-retire, again, we hit another downhill plunge in the markets. Well, sure, this portfolio, it's going to be down some in value because you got some exposure to stocks, but it's not going to be down nearly as much as someone who kept this circle all in yellow. And that's what happens. You get a lot of adults, they forget about asset allocation. That's exactly what happened in 08 and 09. I cannot tell you the number of headlines I saw about that. And if you would have looked, a lot of those adults probably had too much of an allocation of stocks. So you've got to keep this in mind as you get older, closer towards your investment goal. Get off that roller coaster ride with your portfolio. Start riding the teacups or the monorail to smooth out the potential for that downhill plunge. Final part with a chart, and then one or two more slides, and then we'll get you on your way. A lot of people will say, well, Doug, how do you know when the markets are going up or down? No one knows for sure. You can watch the business channels. People will speculate. No one truly knows for sure. For general consumers, the best way to take the advantage of the ups and downs in the market is like we just talked, a set dollar amount per paycheck. If you're doing $50 each paycheck and we're in a bear market, you're able to afford a lot more shares because they're so cheap. Likewise, a year later, maybe we go up into a bull market. Now those share prices are really expensive. Why try to put in more than $50 a paycheck? Share prices are expensive. You're not going to be able to afford any more. So by capping it still at $50 a paycheck, you're being smart. You're buying, but you're not overbuying. Only way I'd say to raise it is if you get a raise, you can maybe make it 51 or 52 per paycheck. By all means, do that. That, ladies and gentlemen, is dollar cost averaging, just a set amount on a regularly occurring basis. If you want to read more on dollar cost averaging, simply grab the basics booklet. Pages 11 and 12 do a great job of talking about that. For asset allocation, pages 7 and 8 in the 5 Keys booklet. Final part here in our remaining 2 minutes, I want to just briefly talk about compound interest. When you get a chance, I want you to Google compound interest just to see how powerful it is. And I think some of you have an idea. I always like to think of this as a snowball of cash, of course, and really think of that snowball as being your savings and investment account, all right? And every paycheck, you're going to put a handful of cash, a handful of snow in there, all right? So that's gradually going to grow in size. Then every month or every quarter, you're going to earn those interest and dividend payments. When these interest and dividend payments come in, throw them on top of your snowball. Makes it a little bit bigger. You keep adding in more money each paycheck. So then that next round of interest and dividend payments is going to be a little bit larger. So you get the picture here. You keep doing this over the long term, over a good 10, 20, 40 years. This eventually is what your snowball is going to look like. But ladies and gentlemen, to get the big size of the snowball, you got to reinvest those interest and dividend payments. That's going to be the big key. Final point here, let's just do a little example. I always like doing these. Let's start investing $84 a month right now for the next 25 years. I see the look in some of your faces. Doug, where am I getting $84 a month? It just breaks down to $280 a day. So if I could do that for 25 years, get a 5% average annual rate of return, which is actually kind of low over that time span, here's what we could likely end up with. Not going to go off and buy a tropical island with this, and yeah, some of this is the money you've been putting in, but it's a decent chunk of change. But let's say every time you got those interest and dividend payments, you just went out and spent them, you didn't reinvest it. This is what we're looking at, all right? So again, this is why it is so important to reinvest those interest and dividend payments. If we bump this up to $100 a month, $330 a day, here's what I'd likely end up with. And let's just have a little more fun with one more picture. Had I started my senior year, when I was graduating back in 2001 from Shippensburg, started with $84 a month in 2001, would do that each year through the year 2036 when I could likely wrap things up in this job. Here's what I could likely end up with, all right? This is what we're talking about, that financial marathon, doing this over the long run. And one more quick example for anyone who's an undergrad in here, if we would have started sophomore year, if I would have started 2 years earlier, look at the difference now. So I think you guys get the picture with this. Get in that habit. You're in that financial marathon. Ladies and gentlemen, we appreciate your time. Have a good day.